Good morning, students. Welcome you all on the live virtual classes organized by Board of Studies of ICAI. I am CA Alok Kumar Garg. So today I am taking a session on Ind AS 16 Property, Plant and Equipment, which is a part of your paper 1 of financial reporting of CA final. So friends, if I talk about the accounting standard or Indian accounting standard, there are two set of standard which is prevalent in India as of now. One is accounting standard, which is known as a AS. The second one is Indian accounting standard, which is known as a Ind AS. Okay. So accounting standard is applicable, and accounting standard are our old accounting standard, which you must have read in IPCC or CA Inter. And in the financial reporting curriculum, Ind AS is applicable and Ind AS are there. So these Ind AS are applicable on the listed companies. These Ind AS are applicable on the companies which are having a net worth of more than 250 crores. So I hope you are aware of all this fact. So today's session is on Ind AS on asset-based standard. So we are talking about fixed assets today. We are talking about property, plant and equipment today. We are talking about tangible assets today. Okay. So this is the first session, first standard on asset-based standard. Okay. So friends, one comfort I want to give you that under accounting standard AS 10 is there. Accounting standard 10. Okay. This AS 10 talks about accounting for fixed assets. But this standard got revised on 30th March 2016. So if any of you is having a knowledge of accounting standard 10, revised accounting standard 10, then substantially you are aware about Ind AS 16. Okay. So in Ind AS 16 also talks about property, plant and equipment, and under AS 10 on 30th March 2016, the name of the title of the accounting standard 10 has been revised from accounting for fixed assets to property, plant and equipment. So technically speaking, this AS 10 is 95% same as of Ind AS 16. So this AS 10 has been amended to brought in line to Ind AS 16. Okay. So if any of you is having a knowledge of AS 10, then you are having a knowledge of around 95 to 96% of Ind AS 16. Now the question arises, sir, what we are going to read or what we are going to learn under this particular standard? So let me tell you the boundary of this standard. Okay. Let me tell you the syllabus of this standard, this particular standard, property, plant and equipment. So this standard talks about property, plant and equipment. I mean to say tangible fixed assets. I hope my voice is clear to everyone. I hope the board is visible to everyone and you guys are comfortable in every manner. Okay. So friends, first of all, every standard starts with the objective. For example, if I'll ask you why you are attending this class, you will say, sir, we want to clear CA final examination. That is why we are attending this class. It means you have an objective. You have an objective. Okay. So that is why every standard starts with the objective. So as far as the boundary of this standard is concerned, so we'll see what is the objective of this standard. Objective. Then there should be a syllabus, there should be a boundary, there should be a parameter. So this standard also talks about scope, where this standard is applicable. First of all, why this standard, which is known as objective, then where this standard is applicable, what is come under the purview of Ind AS 16, what will not come under the purview of Ind AS 16. So second one is scope, objective, scope. Okay. Then we are discussing the scope, whether software will be coming under this standard. Software. So guys, I'm asking whether software will come under this standard. Perfect. So 2-3 participants have confirmed that there is no problem in voice as well as whiteboard. Great. Perfect. So software will not come under this standard. Why? Because software is an intangible asset and this standard only talks about tangible assets. Okay. So we will be discussing later on. Then This standard talks about recognition. What is meant by recognition? What is meant by recognition? It means, for example, you have purchased a factory, you have purchased, or the company has purchased a truck. So whether that truck has required to be charged to P&L, or that truck is required to brought into the balance sheet as an asset. Okay, if it has to brought in as a balance sheet, as an asset in the balance sheet, then under which line item? Is it a property, plant and equipment? Is it a intangible asset? Is it an investment property? Is it a biological asset? So we need to see. So the thing is recognition. So how a particular item is going to be recognized under this standard. Okay, so we will be talking about the recognition criteria. If you have acquired or purchased a truck, whether it is required to be recognized as a property, plant and equipment. So what are the conditions, what are the criteria we are going to discuss. Okay, if I'm talking about recognition, this recognition has been split into two parts. One is initial cost. One is initial cost. Initial costs. For example, the company has bought a truck and the company has incurred, let's say, 25 lakh rupees on acquiring a truck. So this is known as an initial cost. The second one is subsequent cost. Subsequent cost. What is meant by subsequent cost? Let's say the truck has a good life of 10 years, 15 years. Okay. After 5 years or after 4 years, the engine of truck is required to be replaced. The engine of the truck is required to be replaced. And it will take around 5 lakh rupees to replace an engine. So it is a major overhauling cost. It is a major repair and maintenance cost. So what will be the treatment of this subsequent cost? So we will be discussing later on about the subsequent cost recognition. Also, whether it will be charged to P&L or it will be capitalized as a part of property, plant and equipment. So we will be discussing. Okay. For example, if the company, there is an aviation company and that aviation company is engaged into the business of flying the passengers, business of taking the passengers from one location to another location, like Air India, like Jet Airways. So Jet Airways is no more, but of course your Indigo Airlines, okay, Vistara Airlines. So these airlines are engaged in getting the passengers from one location to another location. So there is a requirement of aviation authority or aviation rules that since these aircrafts are dealing with the lives of the passengers, so these aircrafts are required to have a mandatory inspection after a particular intervals. Okay, and that inspection will carry a major cost. So what will be the treatment of that inspection cost? We will be discussing under the recognition criteria under subsequent cost. I hope you guys are clear so far. Guys, just I want your confirmation. I hope you are okay so far. We are only talking about what is the coverage of this particular standard. Okay. After recognition, so we will be discussing your initial cost, your subsequent cost. Then after recognition, we will be discussing the measurement. So first of all, we have decided that this item is required to be recognized as a PPE under Ind AS 16. Then we need to ask at what value? At what value? Because for getting an item into the financial books of accounts, there must be a value. Okay. So it means measurement. It means measurement. Okay. Measurement. If I talk about measurement, I request everyone to please write down this chart or write down this concept in your copy or in your notebook. Okay. If I talk about measurement, there are two kinds of measurement. One is at recognition, after recognition. Measurement at initial recognition. Measurement at initial recognition. Initial recognition and measurement after recognition. After recognition. What is meant by measurement at recognition? Measurement at recognition means measurement at recognition means at the transaction date. For example, the company has acquired a truck, the company has purchased a machinery on today is 5th of December, on 5th December 2020. Okay, so it means this machinery or truck is required to be recognized is an initial cost, and at what value? So that machinery and truck is required to be recognized at cost, okay, which is as on date, which is on the date of purchase. So this is known as initial recognition. But when 31st March will come, when 31st March will come, 31st March 21, what will you do? You will charge a depreciation. You will do the impairment testing. Okay. So these all things are known as measurement after recognition. Measurement after recognition. Probably you will do the revaluation of that machinery. Have you heard the concept of revaluation under AS10? Have you heard the concept of revaluation? Yes. Yes. So participants are saying yes, sir. We have heard the concept of revaluation model under AS10. So probably if you have to do the revaluation on the reporting date, so this is after recognition. So what is meant by initial recognition? Initial recognition means recognition at transaction date. What is meant by after recognition or subsequent recognition? It means at a reporting date, which is 31st March. So as far as measurement is concerned, we will be discussing measurement at initial recognition, measurement after recognition. Once the asset has brought into the books of accounts, then at the reporting date, at the year-end date, at the reporting date, so what is required to be do with the value of that asset? That is known as a after recognition. Okay, great. So fantastic, guys. Ambika, Pujita, Priti, Kaustav, Chavi, great, fantastic, guys, fantastic. Okay, so measurement at recognition. So measurement at recognition, under measurement at recognition, we will be discussing about that at initial recognition, the asset has to be recognized at cost. The asset has to be recognized at cost. Okay, so we will be discussing about the cost model, and we will also be discussing what will be the element of cost. What will be the element of cost? Okay, what will be the elements of cost? So what is included under cost? We will be discussing. For example, a company has purchased a machinery from China. So first of all, purchase price will incur, then import duty will be there, then machinery will come from China port to, let's say, Kandla port in India. Okay, so there is a freight and forwarding charges. Then machinery will come to Kandla port to the location of the factory. There is again a transportation cost. Then there will be installation cost. There could be inspection cost. There could be a trial run cost. So what are the costs which is required to be capitalized as a part of the machinery? We will be discussing under this standard. Okay. So as of now, I am only creating the base of this standard. I am only creating the fundamental of this standard so that you will understand what we are going to learn under this particular standard. Okay. Measurement after recognition. So after recognition, we will be discussing that after recognition, it has to be carried at cost model, or it could be carried at a revaluation model. Revaluation model is pretty important under this standard, and there is a new concept of revaluation model. There is a new concept under revaluation model. Under Ind AS 1, you must have read a concept of other comprehensive income. Am I right? Chavi, am I right? Ambika, Pujita, am I right? Are you aware about the concept of other comprehensive income? Yes. So participants are saying yes, sir. We have already understood the concept of other comprehensive income. Great. Great, guys. So we will be discussing the revaluation model, and we will be discussing the depreciation concept. So depreciation concept is also part of measurement after recognition. As I told you, you will also charge depreciation at the reporting date. Okay. Then under depreciation, we will be discussing a lot of concepts, like what are the depreciation method, what is the depreciable amount. Okay. So what is the different depreciation method? What is the depreciable amount? What is the technique of depreciation? What is meant by depreciation? Then we will be discussing impairment. So impairment is also a kind of a excess depreciation. You are required to see whether my value in the books is higher than the value which is there in the market. I mean to say recoverable value is higher or recoverable value is lower, but carrying value is higher. It means there is a need for impairment. So we will be discussing impairment also under this particular standard. Okay, great, great friends. Then then we will be discussing the concept of, after this we will be discussing the concept of derecognition. It means, so sir, we have discussed when an item has to be recognized as a PPE under this standard. Then we discussed at what value that item is required to be recorded under the books of accounts. Then we discussed, sir, after recognition, I mean to say at reporting date, at what value it has to be carried in the books of accounts. Okay. Then we will be discussing what is the derecognition criteria, when an item has to be removed from the books of accounts. Okay. So can any of you tell me when an item has to be removed from the books of accounts? Since you all are the commerce student, you are the student of CA final. So tell me, कब उस item को हम book से हटाएंगे? When an item is required to be removed from the books of accounts. Guys, just let me know quickly. I hope you all are comfortable here. Okay. So this is the entire journey of this particular standard. Disclosures are also there, which is a theoretical part, and you just have to run through the disclosures. Okay. I will not be focusing on the disclosure. Just you have to run through the disclosure. But as far as practical part is concerned, so we are covering in this entire stuff under this particular standard. Okay. Objective, scope, recognition, initial cost, subsequent cost, measurement at initial recognition should be at cost. Okay. Then we will be discussing elements of cost, measurement after recognition. There are two model, cost model, revaluation model. We are also discussing the concept of depreciation, and we will also be discussing the concept of impairment. Then we will be discussing the concept of derecognition. Okay. Now move to the next concept. Now I am switching on to my PowerPoint presentation just for the first two theoretical part. I hope this presentation is visible to everyone. I hope this presentation is visible. So coming to the objective. So let me see if there is any query. So Pujita has told no future economic benefit or when it is scrapped. Ambika, Chavi, Priti, Kaustav, yes, you all are right. So my query was when to derecognize the item from the books of accounts. So you all are right. Perfect. Great guys. Really, you are great students. Thanks. Objective. So what is the objective? Of course, this standard talks about the accounting treatment for property, plant and equipment. Okay. So accounting treatment, I mean to say, the measurement of the property, plant and equipment, the depreciation part, the impairment part, the recognition part, derecognition part. So as far as accounting treatment for property, plant and equipment is concerned, it talks about the recognition of the asset. It talks about the determination of carrying amount. What is meant by carrying amount? Carrying amount is the amount on which the asset is required to be carried in the books of accounts. Carrying amount. Carrying amount means the amount at the reporting date. Okay. So carrying amount could be your cost minus depreciation minus impairment. Okay. This standard also talks about depreciation charges. As I told you that we will be discussing the concept of depreciation also under this particular standard. This standard also talks about impairment losses when the company is required to charge the impairment on a particular asset. Okay. Coming to the scope part, so Ind AS 16 is applicable to all kind of all kind of property, plant and equipment. It is applicable to all kind of property, plant and equipment except PPE classified as held for sale. Except PPE classified as held for sale. Okay. Except biological asset related to agricultural activity. So technically speaking, if somebody will ask you, Ambika, Vaibhavi and Kausav, Pujita, what is the coverage of Ind AS 16? Ind AS is applicable to what? Then you should say Ind AS is applicable to all kind of property, plant and equipment, all kind of. So it means it covers everything. It covers everything. I mean to say all kind of property, plant and equipment. We will learn the definition of property, plant and equipment, but you will say every kind of property, plant and equipment, be it a factory, machinery, furniture, car, office equipment, television, refrigerator, printer. Okay, so every kind of property, plant and equipment except, so exclusions are there. So what are the exclusions? If an item is specifically covered by a particular standard, then it is not come under the purview of Ind AS 16. The first one is PPE classified as held for sale. Okay, so there is a separate standard, Ind AS 105. Ind AS 105 talks about the property, plant and equipment classified as held for sale. So for example, a company has two machinery. One machinery is used in the production, and the second machinery, the company has an intent to sell that particular machinery. Okay, that machinery is not used in the production, or company does not want to continue that machinery for the production, and the intent is to sell that machinery. So in this case, that particular machinery will come under Ind AS 105 and it will not come under Ind AS 16. Okay. Biological asset related to agricultural activity. So under Ind AS 41, there is a standard known as agriculture. Under agriculture standard, you will learn biological asset related to agricultural activity. So if there are biological asset which is related to agricultural activity, then those biological asset, let me clear here. Biological asset means living animal or plant. Okay, sir, if there is a land and the land has been used for agricultural activity, tell me whether it will cover under Ind AS 41 or Ind AS 16. Guys, my question is, there is a land and the land has been used for the agricultural activity. So whether that land is covered under Ind AS 16 or Ind AS 41. The exclusion is biological asset related to agricultural activity, and the meaning of biological asset is living animal or plant. Biological asset. So is it covered under Ind AS 16 or Ind AS 41? So land will be covered under Ind AS 16. Land is not a biological asset. It is covered under Ind AS 16. Okay. Recognition and measurement of exploration and evaluation assets, mining assets. So guys, you have learned the concept. So you are aware that there is a standard known as the Ind AS 106. This Ind AS 106 talks about the recognition and measurement of exploration and evaluation assets. Okay. So if there is a exploration and evaluation assets in case of a mining companies, so that exploration and evaluation asset is outside the purview of Ind AS 16 and it will be covered under Ind AS 106. Okay. And likewise, mineral rights, mineral reserves such as oil, natural gas, and similar non-regenerative resources. So these are also covered under different standard. These will not be covered under Ind AS 16. Okay. So we have talked about four things. So one is it is applicable to every PP except PP classified as held for sale, biological asset related to agricultural activity, and the assets related to exploration and evaluation of mineral assets. Okay. But for example, in case of a mining company or mining industry, there are some trucks, there are some lorries, there are some cranes which are engaged in the extraction of that mining ores. Okay. In that case, if a property, plant and equipment which are used to develop or maintain the above assets, that will be covered under Ind AS 16. Okay, so I have taken an example of the property, plant and equipment or assets which are engaged in the mining activities. Or for example, there is a tractor which is engaged in the cultivation of the land which is related to agricultural activity, or land which is related to agricultural activity. So these are covered under Ind AS 16. I hope you guys are clear so far. I hope so. Friends, are you clear here? Can I move forward? So we talked about the objective part. We have spoken around this scope part. So it is applicable to every kind of PP except technically three. One is except PP classified as held for sale, which is covered under Ind AS 105. Second one is biological assets related to agricultural activity, which is again biological assets related to agricultural activity. I mean to say living animal or plant. Okay. And we talked about the mineral rights and exploration and evaluation of mineral assets. That is also covered under Ind AS 106. If there are some assets which is related to these activities, of course, those assets are covered under Ind AS 16. Great. So just one concept I want to highlight here. When I'm talking about biological asset, so I told you that biological asset is covered under Ind AS 41, agricultural. Okay. So biological asset. There are two kinds of biological assets. Okay. So two kinds of biological assets. One is consumable biological assets. Consumable biological asset, I am talking about only the plant side. I'm talking about the plants. Okay. For example, tomato plant. So whether tomato plant will provide the tomatoes at every year, or it is giving a fruit, or it is giving a tomato in only one season. Okay. So this provides a tomato only in one season or two season maximum. Okay. So technically speaking, this tomato plant will finish within a year. Okay. But if I talk about mango tree, whether mango tree will survive for years, or mango tree will provide a fruit only only for a particular year. So it provides fruits for multiple years. For example, if I talk about tea bushes or tea plant, so tea plant will survive for 100 of years. Okay, the person will pick the tea leaf. Okay, like coffee plant, it will survive for 100 of years. So coffee bushes or coffee leaves will be picked for the harvested produce. Okay, so under biological asset there are two bifurcation. Okay, if biological asset will provide the produce or provide the output for more than 1 year, it will be considered as a bearer plant. Okay, it will be considered as a bearer plant. Bearer plant. Okay, bearer plant means the plant which bear the fruits or output for more than 1 year. For example, rubber tree. For example, palm tree, mango tree. Okay, so these provide fruits for more than 1 year. So these are known as a bearer plant. Okay, but if a plant provides the fruits or provides the vegetables in a particular year, okay, for example, all the herbs, okay, coriander, or let's say dhania, palak, so these items are providing the output within a year. Okay, so these are not carried forward to the next year. So these are known as a consumable plant, and these will be covered under these consumable plants. I call it as a consumable plant. These will be covered under Ind AS 41. But if it is a bearer plant, it will be covered under Ind AS 60. So you need to remember this fact. Okay, guys, are you clear on this? Are you clear on this? Vaibhavi, are you clear on this? Great, guys. So now I am taking you on the most important part. Sir, the title of the standard is PPE, property, plant and equipment. Now, what is meant by PPE? What is meant by property, plant and equipment? Okay. What is meant by property, plant and equipment? Okay. So definition of property, plant and equipment. First of all, property, plant and equipment is a tangible item. It is a tangible item. Am I right? It is a tangible item. Tangible item. It is a tangible item. What is meant by tangible item? You can touch, you can see, you can feel. Okay. So that is why software is not a tangible item and it is not covered under Ind AS 16. So tangible item. Okay. Which is held for. Tangible item held for use in, held for use in. So the tangible item held for use in production, or supply, of goods and services, So first of all, tangible item, the purpose of the tangible item, that the tangible item is held for use in production or supply of goods and services. For example, machinery. Machinery is held for production of goods. For example, truck is held for supply of output, supply of goods. Okay. So tangible item held for use in production or supply of goods and services, or held for rental purposes, or held for administrative purposes, Okay. And so tangible item held for use in production or supply of goods and services, or rental purposes or administrative purposes, and expected to be used, for more than one period, technically more than 1 year, for more than one period, one accounting period, for more than one period. Okay. Okay. Now let's have a more control on this particular definition. So tangible item held for use in production or supply of goods and services, which is held for rental purposes or administrative purposes and expected to be used for more than one period. For example, sir, we have acquired a small machinery, okay, and the life of the machinery. So of course that machinery is a tangible item. That machinery is held for use in the production of goods or services, okay, production of goods, okay, and the life of the machinery is, let's say 50 running hours or 100 running hours. There is a special type of machinery which will run for 100 hours, okay, and this machinery is expected to be finished or expected to be unproductive within a year, or let's say in 4 months or 5 months. Do we require to capitalize that machinery as a PPE? So that is not meeting the definition of PPE. Why? Because this first leg is getting satisfied, the second leg is getting satisfied, but the third leg is not getting satisfied because it is not expected to be used for more than 1 year or more than one period. Okay, so it can be expensed off. Okay, it is not meeting the definition of PPE. Second example, sir, we have acquired a furniture. So furniture is not engaged in this production of goods or supply of services. Whether the furniture will come under the definition of PPE? Answer is yes. Furniture is a tangible item. It is expected to be used for more than one period or more than 1 year, and it is held for administrative purposes. Okay, so furniture will be covered here. Sir, what is meant by rental purposes? Have you seen the construction site? So there are some machinery, there are some cranes which is there on the construction site. There are some mixer machines, okay, which is mixing the cement and the other stuff, sand and the other stuff for construction, okay. So these all item has been hired on a rental basis, okay. So the company which bought some machinery, and the objective is to rent out or let out those machinery and to earn rental. So those machinery is not engaged in the production or supply of goods and services, but those assets are engaged in the rental purposes. So these items are required to be capitalized as a property, plant and equipment. Have you seen the coffee vending machine? The coffee vending machine of CCD, Cafe Coffee Day, in a company's premises. Have you seen that? Like in my company, there is a coffee vending machine which is provided by Cafe Coffee Day. So Cafe Coffee Day used to charge a rental on those on using those vending machines. Okay. So in the balance sheet of Cafe Coffee Day, these coffee vending machines is capitalized as a PPE. Why? These are tangible item, of course, expected to be used for more than one period, of course. And these coffee vending machine has been provided on a rental basis. Okay, these are held for use for rental purposes. Okay, so that is why it is capitalized as a PPE. Understood? Guys, have you understood? But there is one exception. There is one exception to this particular rental piece. One exception. What is the exception? Have you heard about Ind AS 40? So in the series of asset-based standard, I'll take one more standard, Ind AS 40, which talks about investment property. Guys, please revert. Have you heard about Ind AS 40? I request, the more you interact, the more you learn. The more this session will be interactive. And I hope you guys are comfortable. You guys are able to understand what I am trying to say. Am I able to deliver properly? Great, great. Thanks. Okay. So what is the exception? I have told you that there is one standard which talks about investment property. If a building or a land, or a building which is provided for rental basis, okay, the company has acquired a building and the intent is to provide that building on a rental basis, okay, let out that building and to earn rental, okay. So if that particular land and building has been held for use for a rental purposes, in that case it will not covered under PPE, it will be covered under investment property. So there is only exception for land and building. So land and building will covered under Ind AS 40 if it is provided on rental basis, okay. But sir, what about other than land and building? Other than land and building, if there is a truck, there is a vehicle, there is a, for example, Oryx Corporation. If Oryx Corporation, no worries. So Kaustav is saying, sir, haven't heard about Ind AS 40. No worries, Kaustav. So there is one more standard, Ind AS 40, which talks about investment property. So I'll take that standard. Okay, it is again a asset-based standard. Okay, so under that standard, land and building, if land and building, the objective is to earn rental or capital appreciation, that it will be covered under investment property. Okay, so other than land and building, if there is a vehicle, there is a machinery or anything else apart from land and building, if the objective of the company is to earn rental from that particular asset, it will be covered under Ind AS 60. Okay, guys, is it okay? Great, great. So now I am putting on my PowerPoint presentation just to deliberate more on this particular standard. So we have discussed the definition of PPE. Now, probably this PowerPoint presentation is visible to you guys. There is a definition of PPE case study 1. XYZ Limited has acquired a land to construct a plant for manufacturing of goods. Also acquired below item for the business. Okay. So first of all, the company has acquired a land. So whether land is a PPE. Guys, just revert quickly. The company has acquired a land to construct a factory. Is it a PPE? Yes, land is a PPE. Land is a tangible item. It is held for use in production or supply of goods and services. Okay. It is expected to be used for more than one period. The company has also construct a plant. Whether plant is a PPE? Yes, plant is a PPE. And the company has also acquired below item for the business. Machine A for production. So machine A, whether machine A is a PPE? Tell me. Building for rental purposes, whether building is a PPE? Truck for transportation of goods, whether truck is a PPE? Furniture and fixture for the office administration, is it a PPE? Laptop for the employees for office working, is it a PPE? SAP software for maintaining records and books of accounts, is it a PPE? Identify whether above items are PPE or not. Guys, tell me quickly which item is PPE, which item is not a PPE. Majority of the items are PPE, let me tell you. But which item is not a PPE? You need to tell me. So that will be an easier way of doing. So only 5-6 participants have replied so far. I would request more students to revert. There is a simple formula of learning. The more you interact, the more you learn. The more you respond, the more you get. Guys, what is not a PP under this list? Tell me. What is not a PP? This is a very interesting standard. And let me tell you, this is a very interesting standard and very important standard from examination point of view as well. So Ambika is saying, sir, except building and except software, everything is PPE. So Pujita is saying all are PPE except for SAP. Pujita, I have told you, there is an exception only for land and building. If land and building is held for rental purposes, then it is not a PPE. It will be covered under investment property. Okay. And software, of course, is not a PPE. Chavi, you are right. Building and SAP software is not a PPE. Building is an investment property covered under Ind AS 40 because it is held for rental purposes. Okay. If the building is held for office administrative purposes or business purposes, then it will be PPE. But if a building is held for rental purposes, then it will not be a PPE. It will be covered under investment property. Okay. So this is the answer in your screen. Are you able to see the answer? Land is a PPE, plant is a PPE, machine is a PPE, building is an investment property because it is held for rental purposes. If the building is held for business purposes, for use in the own business, it will not be a PPE. Truck is a PPE, furniture fixture is a PPE, laptop is a PPE, SAP software is not a PPE because it is not a tangible item, it is an intangible item. Although the second and third leg is meeting, probably the software is used for administrative purposes. It has a life for more than one period, but it is not a tangible item, it is a intangible item. Okay. Guys, are you okay? Okay, great. Perfect. Fantastic, friends. So, is there anyone who has not understood the definition of PPE? Tell me. Anyone who has not understood the definition of PPE? Guys, let me know. It is very important to learn. Let me know if any of you has not understood the definition of PPE. Okay, fantastic. Everyone is saying, sir, that we are clear on this. Siddharth is also comfortable. Pujita is also comfortable. Great, guys. Wonderful students. Thank you. So now I'm moving on to the next part. So we understood the definition of PPE. Now I'm moving when an item is recognized as a PPE. Okay. when an item is recognized as PPE. And one more thing I want to tell you, that you guys must have a study material, because in these classes the examples, the practical problems, case studies will be taken from the study material apart from our own examples. Okay, so you have to refer the study material, first thing. Second, you have to refer the study material which was printed on August 2019. So that the material is also available on the website of ICAI. Okay, so you have to refer that, because when I say the page number, when I say the question number, so I am referring to the study material which have been published or reprinted in August 2019. Okay, August 19. Yes, so revised edition is August 19, reprint is February 20. Great. So now I'm moving on to the recognition criteria. Can anyone help me in understanding, sir, when an item is recognized as a property, plant and equipment? I'm asking, for example, a company has, so I'll give you 3 examples. Okay. Example number 1. A company has acquired or purchased a diesel vehicle. Purchased a diesel vehicle. Okay, purchased a diesel vehicle for rupees 10 lakh. Purchased a diesel vehicle for rupees 10 lakh. Okay. The moment the company has acquired a diesel vehicle, instantly on that day, government banned use of diesel vehicle, use of DV, diesel vehicle. Okay. Second example. Company has purchased a machinery. Okay, purchased a machinery. Third example. A Limited, sorry, government provided an asset to company, the value is not known or cannot be derived. The value is not known. Okay. Have you understood the example? So I am discussing the recognition criteria, and I have given you 3 examples. Okay, 3 examples. I mean to say, I've given you 3 situations. The first situation is the company has purchased a diesel vehicle for rupees 10 lakh. The moment the company has purchased a diesel vehicle, government has banned the use of that particular vehicle. Second example, the company has purchased a machinery. Third example, government has provided an asset to the company and the value is not known for that particular asset and the value is not identifiable. Okay. Now, my question was, what is the recognition criteria of a particular asset? So the recognition criteria is, what is the recognition criteria? The recognition criteria is recognition. The recognition criteria is, first, future economic benefits should be probable. FEB. Siddharth, FEB. What is meant by FEB, Pujita? Kaustav, Neha, what is meant by FEB? Chavi, Ambika, Priti, Vaibhavi. Future economic benefit FEB, future economic benefit should be probable. So it is expected, it is probable that future economic benefit will be received by using that particular asset. So future economic benefit should be probable. Future economic benefit should be probable. For example, when you will use the machinery, then what will happen? The machinery will produce goods, and the company will earn the money from selling the goods. The company will use the truck. So the company has purchased the truck. The company will use the truck for supply of goods. Okay. So the company will get the money out of it. Okay. So future economic benefit should be probable. Second, and this is plus, and cost can be measured reliably. 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 Okay, understood? So guys, for recognition of any asset, I am giving you a mool mantra. I am giving you a fundamental concept. For recognition of any type of asset, there must be two conditions globally. There could be more than two conditions, but these two are the basic conditions. First, you are expecting a future economic benefit out of using that asset. So future economic benefit should be there. The second, you must be able to quantify, or you must be able to determine the cost of that particular asset. Okay. So these two criteria must be satisfied for recognizing a particular item as a PPE. Sir, if we will not recognize a particular item as a PPE, for example, we have acquired a machinery. So the company has acquired a machinery which is used for a particular type of production of a particular type of product which can be exported. Okay. So the company has acquired a machinery from Japan, and that machinery is used for producing a specific type of product which can be exported to China. So there is no indigenous consumption of that particular product. The company cannot sell that particular product into a Indian market or any other market. That product is specifically used for China, exclusively for China. And the government has banned that product. The company cannot export that particular product to China. So now what will happen with that particular machinery? That machinery become unproductive. Okay, because whatever output will be produced by that particular machinery, that can only be used by the China. Okay, and the government has banned the export to China. I'm just taking an example. So guys, in that particular case, if the company has acquired a machinery and government has banned the output which is produced from that particular machinery, it means cost is known, but future economic benefit is not probable. In that case, it will not be capitalized as a property, plant and equipment. It has to be expensed off, or probably if that particular item is held for sale, it will be covered under Ind AS 105. Okay, but it will not become under the picture of Ind AS 16. Now analyzing these three situations, the company has purchased a diesel vehicle for 10 lakh and government has banned the diesel vehicle the moment the company has acquired that. Guys, tell me, is it recognized as a PPE? Is it recognized as a PPE? Cost is known. We know that it is for rupees 10 lakh. Cost is known. Please reply quickly. We have to cover so many concepts. There are a lot of concepts in this particular standard, and we have allotted only 2 sessions for that. But 2 sessions are more than sufficient. But of course, we need to do a lot of case studies also. Guys, what about the first situation? The cost is known, it is 10 lakh, but whether future economic benefit is probable, whether the company can get the future economic benefit, yes or no? Great. Rohan is saying, sir, the cost is known, but future economic benefit is not probable because the government has banned. Absolutely perfect, Rohan. Absolutely perfect. Yes. So it is not recognized as a PPE. Okay. What about the second part? B, purchase of machinery. So assuming the company has purchased a machinery, of course, in case of purchase, the price is known and it will provide future economic benefit. So it will be recognized as a PPE. So the first item is not a PPE. The second item is a PPE. What about the third item? Let me see if more students have replied this. So Ambika is saying, sir, only point number 2 is a PPE. Rest of all is not a PPE. Great, Ambika. The third one is government provided an asset to the company. So government provided an asset. Government has given a grant like for an asset, non-monetary grant. Of course, there is an asset. So future economic benefit is probable. But the cost is neither measurable nor known. The cost is not known. In this case, it will not be recognized as a PPE because the cost is not known. Okay. So the two conditions, future economic benefit should be probable and cost can be measured reliably. Okay. So we understood that if an item has to be recognized as a PPE, two conditions should be satisfied. Future economic benefit should be probable and cost can be measured reliably. What is PPE? It is a tangible item which is held for use in production or supply of goods and services, or held for rental purposes, or held for administrative purposes, and which is expected to be used for more than one period, which is technically more than 1 year. Now one more question. Sir, for example, the company has purchased a furniture. Okay. The company has purchased a chair. The cost of the chair is 3,000. So if I talk about chair, of course it is a tangible item. Of course, it is held for administrative purposes. Of course, this chair is useful for more than 1 year. Okay. Sir, can a company make a policy that the item below 10,000 or item below 5,000 can be charged off to P&L as and when they have been incurred? Okay. Can the company prepare this kind of policy? So students, when you read Ind AS 1, there is a concept of materiality. Concept of materiality lies everywhere in the accounting standards. The company can make a policy that the immaterial item or the item of an immaterial value like 3,000, 4,000, 2,000, these can be charged off to P&L as and when they incurred. So this policy can be formed by the company depending upon the materiality. Okay. For example, if I talk about Reliance Industries Limited, if you will see the balance sheet of Reliance Industries Limited, so they have around 1 lakh crore of PP. They have around 1 lakh crore of PP. So friends, in 1 lakh crore of PP, do you think that 5 lakh rupees is material, or let's say 1 lakh or 2 lakh rupees is material? It is not material at all. So you need to look at the materiality concept. You need to look at the materiality at the entity level. And if the item is not material, the company may make a policy with a disclosure in the notes to accounts. Okay. But the underlying principle is, what is the underlying principle? The underlying principle is if future economic benefit is probable and cost can be measured reliably, that item is required to be recognized as a PPE under Ind AS 16. Okay. Great. Now remember when we were talking about recognition of PPE, we have talked about two concepts: initial cost and subsequent cost. Recognition. We understood the recognition criteria, but when we talk about recognition, we are talking about two items. One is initial cost, recognition of initial cost, recognition of subsequent cost. Subsequent costs. Okay. Recognition of initial cost, recognition of subsequent cost. So for both these items, the criteria is same. For both these items, the criteria is same. What is the criteria? You need to look at whether future economic benefit is probable and cost can be measured reliably. Cost can be measured reliably. Now I'll ask one thing. Sir, what is meant by subsequent cost? What is meant by subsequent cost? What is meant by initial cost? Initial cost means when the company has acquired a truck, whatever amount the company is incurred on purchasing the truck, it is an initial cost. It is a initial cost. Okay. It is an initial cost. But after 5 years or after 6 years, so remember, I have taken an example of truck. But after 5 years, so when the company has acquired a truck, the company has expense of 25 lakhs. So this is an initial cost. Okay. After 5 years, the company has incurred a major cost. The company has incurred a major cost on replacing the engine, of the truck for rupees 5 lakhs. So what is this? This is known as a subsequent cost. Now, what will be the treatment of this subsequent cost? Tell me. I need to understand from you guys, what is your view on this? So all agree, when the company has acquired a truck, when the company has expense of 25 lakhs of rupees, the company has capitalized. Okay, the company has capitalized. It has to be recognized as a PPE. It has to be recognized as a fixed asset. But when the company has expense of rupees 5 lakh on replacement of engine, then what will happen? The life of the truck is 15 years. I want to understand from you guys that what is your view, whether this 5 lakh rupees has to be recognized in P&L or whether this 5 lakh rupees has to be capitalized as a part of the truck and it is going to be depreciated over the remaining life. Ambika is saying, sir, subsequent cost is like repair which enhances economic value of the asset. Okay. But Ambika, what should be the treatment? Whether we need to charge 5 lakh rupees into P&L or should we add this 5 lakh rupees to the cost of the asset? What should we do? And what about others? Guys, be comfortable. If you are not able to understand any concept, just let me know. Don't hesitate. So you know, this is one of the best feature of online classes, that there is no direct interaction. Okay, so you can without any hesitation you can ask anything. So this is the one of the best feature and fancy of these online lectures and classes. Okay, so Preeti is saying, sir, 5 lakh rupees has to be capitalized. Ambika is saying subsequent cost if enhances the economic benefit to the asset. Okay, Kostav is saying subsequent cost will be capitalized as PPE. Pujita is saying it should be capitalized, it increases the productivity. Okay, so technically speaking, these 7-8 students who have responded, these all are saying, sir, it has to be capitalized as a PPE. Pujita, I want to highlight one thing here. The concept of subsequent cost has been changed under Indian GAAP as well as it is different under Ind AS. Okay, when we were reading accounting standard AS 10 3 years back, if I talk about the situation under accounting standard before 2016, it says that if you are expensing any cost on a particular asset, अगर आप किसी particular asset पे कोई खर्चा कर रहे हो, and if it is increasing the existing capacity or enhancing the existing capacity of the asset, then that expense is required to be capitalized, otherwise not. But now the concept is different. The only concept is that the recognition criteria for initial cost and subsequent cost is same. What is the recognition criteria? Future economic benefits should be probable and cost can be measured reliably. So the company has acquired a truck for rupees 25 lakhs. The life of the truck is 15 years. After 5 years, the truck needs a major replacement cost in terms of engine. Now tell me, if the company will not replace the engine, whether the company is able to run the truck for the next 10 years. Whether the company is able to run the truck for next 10 years. If the company will not replace the engine of the truck, whether the company is able to maintain or run the truck for the next 10 years, answer is no. Answer is no. And when the company will expense off this 5 lakh rupees, I'm not talking about the small repair, I'm not talking about the servicing cost, which is required at every 6 months or 1 year. I am talking about the major replacement cost of an engine, 5 lakh rupees. If a company will expense of 5 lakh rupees at the end of 5th year, whether it will add value only in that particular year, or it will add value to the remaining life of the truck. It will add value to the remaining life of the truck. It will add value to the remaining life of the truck. So first thing, it should not be charged off to the P&L, rather it has to be capitalized as a part of the cost of the truck. Okay. So whether these conditions are meeting, yes, future economic benefit is probable. If the company will replace the engine, the company is able to run and maintain the truck for the next 10 years, and the company will have a future economic benefit. And the cost of the engine is measured reliably. The company knows the cost of the engine, and hence it will be capitalized as a cost of the truck. Okay. Okay. So Siddharth, only beyond standard, this concept is no more. Okay. This concept is no more. Vaibhavi, if the company has expensed any major amount on account of inspection, on account of replacement, on account of major overhauls, then it has to be capitalized as a part of the cost of the asset. Sir, but don't you think that we are doing a duplication? We are doing a duplication. So Pujita is saying it gives value to the life remaining, thus should not be expensed. Yes, Pujita, you are right. Ambika, you are right. Yes. So friends, now a question arises. Sir, you are saying sir, the company has purchased the truck at rupees 25 lakhs. Okay. The life was 15 years. Replacement cost, major replacement cost incurred after 5 years. After 5 years, 4 rupees 5 lakh. 4 rupees 5 lakh. Okay. Now you are saying, let's say the gross block. I am talking about the gross block. I am talking about the gross block. So what is the gross block of the truck? 25 lakh. Am I right? 25 lakh. And sir, you are saying this 5 lakh is required to be capitalized because it is meeting the recognition criteria. So the gross block of the truck will be 30 lakh. Okay. But don't you think when the company has acquired a truck, it has acquired a truck with engine? Am I right or wrong? Am I right or wrong? When the company has acquired a truck, it has acquired a truck with engine. So it means the truck already includes the cost of engine also. It means by capitalizing 5 lakh rupees again as a cost of engine to the truck, you are adding the cost of 2 engine. You are adding the cost of 2 engine in a particular truck. Am I right or wrong? Am I right or wrong? Guys, please respond quickly. Very simple question. Pujita is saying, yes, sir. When you have acquired a vehicle, you have acquired with engine. So that is why you are going to replace. And the life of the truck is 15 years. And hence, you are depreciating this entire truck over a period of 15 years. So even though whatever was the value of that engine, you are also depreciating the engine over a period of 15 years. Okay. So now when you adding this 5 lakh rupees, there is a duplication of cost because there could be a cost of engine associated when you have bought the truck. Then what we need to do with the existing engine? What we need to do with the existing engine which is there in 25 lakhs? Because you are not aware about what is the cost of engine when we have bought the truck. Because when you get the invoice, when you purchase the car, you will not get the invoice. Car body this much amount, engine this much amount, tire this much amount. So you are not getting the component wise breakup. You are getting the value of the entire vehicle. Am I right? So what we need to do? The standard says that in case of subsequent cost, if it is meeting the recognition criteria of cost can be measured reliably, future economic benefit is probable, then it is required to be capitalized. Okay, understood. But what should happen to the existing cost of the component? It says that the existing cost of the component is required to be derecognized. Okay, understood? It is required to be derecognized. But sir, we are not aware that what was the initial cost of engine. Then how can we derecognize? Am I right? Standard says that you can use this value, this 5 lakh rupees as an indicative value. 5 lakh rupees. What does it mean? It means you have to calculate the present value of this 5 lakh rupees before 5 years when you have bought the truck. If today we are expending 5 lakh rupees, then what is the value of 5 lakh rupees before 5 years? Okay. So how will you calculate? Siddharth, you are right. So that is why I am telling you the concept that the initial cost of the engine should be derecognized. But how to calculate that? If you are not aware about the initial cost of the engine, you are not aware about the quotation, you are not aware about the initial cost of the engine, you are required to calculate the initial cost by using the current value. So how to calculate? For example, the discount rate, the current rate of interest is 10%. Okay. For example, for 5 years, if the company will go for taking a loan of 5 years, it will get the loan at 10%. Okay. So 10% is known as a discount rate. Okay. In that case, you have to discount this 5 lakh rupees at a 10% for 5 years, before 5 years. कि आज मैंने 5 लाख रुपए खर्च किए हैं, इसकी 5 साल पहले वैल्यू क्या होगी? So you have to calculate the present value. Okay. So how to calculate the present value? Are you aware how to calculate the present value? Have you aware? So what is the present value of the asset? 5 lakh rupees. 5 lakh rupees divided by 1.1 to the raise 5. Okay. So first of all, you need to calculate the present value factor. So what is the present value factor at the end of 5 years? So let me use the calculator. 1 divided by 1.1. The first year present value. The present value at the end of first year is 0.909. Again divided by 1.1. It is 0.826. Again divide by 1.1. It is 0.751. Again divide by 1.1. It is 0.683. So first, second, third, fourth, fifth. Again divide by 1.1. 0.621. 0.621. Now, if I multiply 5 lakh multiply by 0.621, this will give me 5 lakh multiply by 0.621, this will give me 3,10,500. It means the current value of 5 lakh before 5 years was 3,10,500. So we will assume that in this 25 lakh, What is the initial cost of engine? In 25 lakh, what is the initial cost of engine? The initial cost of engine is 3,10,500. So in the gross block, we have to add 5 lakh minus 3,10,500. 3,10,500. So what is the value of the gross block? 25 plus 5, 30. 30 minus 3, 27. So 26,89,500. Guys, is it okay now? Guys, is it okay now? So Kaustav has a very good point. Kaustav is asking, sir, if we are replacing the engine, it means the original engine is anyways of zero value, okay, and use. What difference will it make if we do not de-recognize the original engine? So Kaustav is asking, sir, you are saying you are replacing the engine. It means the existing engine does not having any value, okay? It does not having any use. Then why you are de-recognizing? So Kaustav, that is why I have started from the gross block concept. I have not started from the net block concept. I have started from the gross block concept, okay? Because in the books there must be a value, there must be a carrying value of that particular engine, because the life of the asset is 15 years, it is not 5 years, okay? So there must be a carrying value which is lying in the books on account of that particular engine, because I have split this 25 into two parts. One is engine, second truck other than engine, okay? So if 3 lakh is the cost of engine, then 22 lakh is the cost of other component of the truck, okay? And again, this 3 lakh and 22 lakh both have been depreciated over a useful life of 15 years. It means there is some net block lying on account of truck also, which needs a de-recognition, okay? Understood? So Ambika is clear. Vaibhavi is clear. Yes, sir. Present value of engine is 3,10,450, whatever it may be. Chavi is again clear. Ambika is saying, sir, but 5 lakh is itself, it's today's present value. So Ambika, 5 lakh rupees is a current value. 5 lakh rupees current value. Okay. I am saying that after 5 years, this 5 lakh rupees have been expensed off. If today I am expensing 5 lakh rupees, then what was the value before 5 years? What was the value before 5 years? So that way I have discounted the 5 lakh rupees before 5 years. Okay. It means if you have deposited 3,10,460 in a bank account, which is fetching an interest of 10%. So if you have deposited 5 years back, so it becomes 5 lakh rupees today. Okay. So we have purchased the truck with engine 5 years back. So that is why I have calculated the present value of rupees 5 lakh 5 years back. Okay, not today. Okay. Siddharth is saying, sir, initial cost must have undergone some depreciation. What about that? Yes, you are right. You are right, Siddharth. You are right. So what will happen with that? So let me explain this part also. But so far you have understood the concept of this major cost, concept of subsequent cost. If there is a subsequent cost, which is material, which is major cost, it is required to be capitalized as a part of the cost of the asset, and the existing cost needs to be de-recognized. If we are aware about the existing cost, we have to de-recognize that amount. If we are not aware, then we need to calculate on the basis of the current cost. Okay. Sir, what will happen if every year we are doing the services, we are getting the servicing done for that particular vehicle or truck? So this labor cost, this servicing cost, day-to-day servicing cost is not capitalized. It has to be charged off to the P&L. Okay. Understood? Okay, great. Now Siddharth is asking about the depreciation part. Let me explain that. So for the sake of easiness of the calculation, let me take this amount as a 3 lakh. Okay. So gross block, gross block, accumulated depreciation, net block. I think everyone is aware about these terminologies. We are reading these terminologies since class 11. We have splitted the truck into two parts. One is engine and other than engine. What is the life of the truck? Life of the truck is 15 years. So engine cost is 3 lakh. I am just assuming, just for the sake of easiness of the calculation. Okay, 3 lakh rupees. What is the cost other than engine? 22 lakh rupees. What is the total cost? 25 lakh rupees. Am I right? Now the life is 15 years. So at the end of 5 years, because we are replacing at the end of 5 years. So what will be the accumulated depreciation till 5 years? 25 lakh divided by 15. The total life is 15. Multiply by 5. So the total depreciation is 8.33 lakhs. The total depreciation is 8.33 lakhs. Okay, and on 3 lakh divided by 15 multiply by 5 is 1 lakh. 1 lakh. Okay, on 22 lakh it is 22 divided by 15 multiply by 5 years has been gone. It is 7.33 lakh. The total is 8.33 lakh. What is the net block? 3 minus 1, 2 lakh is the net block. 22 minus 7.33, 22 minus 7.33, 14.67 lakh is the net block of other than engine, and the remaining net block of the total is 25 minus 8.33, 16.67 lakh. 16.67 lakh. So at the time when the engine had been replaced, the net block is lying at 2 lakh rupees. The net block is lying at 2 lakh rupees. Okay. So it means what accounting entries we need to pass? What accounting entries we need to pass? We need to pass. The gross block is 3 lakh, dep is 1 lakh, and net block is 2 lakh. We need to pass the accounting entry. Accumulated depreciation debit. Accumulated depreciation debit by rupees 1 lakh. To engine. To old engine. To old engine. To old engine by 3 lakh. By 3 lakh. And loss on replacement. Loss on replacement. Loss on replacement debit 2 lakh rupees. So the gross block is credited by 3 lakh rupees. Accumulated depreciation has a credit balance, so it is debited by 1 lakh rupees, and differential, which is net block of 2 lakh rupees, have been recognized as a P&L. So loss on replacement 2 lakh rupees. Okay, understood, sir? But that there is a big engine, so probably it could be sold as a scrap value. It could be sold as a scrap value. For example, the company will get 50,000 rupees by selling it as a scrap value. 50,000 rupees. Then what will happen? Then what will happen? 50,000 rupees. So in that case, the accounting entry will be bank account debit. Bank account debit. How much? 0.5 lakh. And your loss will be reduced from 0.5, which is 1.5 lakh. Okay, 1.5 lakh. Siddharth, are you clear on this? Pooja, Chavi, Preeti, Kaustav, are you clear on this? Guys, tell me, very important concept. Are you clear on this? So Ambika is saying, sir, as you said in the block, there is some amount of net value of truck. Yes, you are right. For example, in this case, we have calculated the gross block of 3 lakh rupees, and 5 years have been gone. So probably 1 lakh rupees has been depreciated. 3 lakh divided by 15 multiplied by 5. The net block is lying at 2 lakh rupees. Okay. So we have derecognized 2 lakh rupees. and you can see the accounting entry. But sir, exact carrying amount will not matches with the present value of engine. In these cases, there might be some cases that some amount may be underecognized. Yes, you are right, Ambika. So Ambika, if you see this, so what we are doing, if we are not aware about the cost, we are just using a surrogated cost. Okay, and in that case, you are right. There could be some minimal or immaterial amount which may remain underecognized. You are right. So that will flow under the remaining part. So it doesn't make any sense, or it doesn't make any difference. You may be right. Yes. Thanks, Preeti. Ambika, is it clear to you now? Guys, are you clear or not clear? Tell me. So quickly, I will do one of the case study which is there in the standard illustration number 8. Yes. So illustration number 8 from the study material of Institute ICAI, page number 7.54. So I'll show you the case study, and so I'm just sharing my screen. I'll show you the case study, and then I'll do the solution of this. Although we have already covered this part. Yes. So this is the illustration number 8, which is there in the page number 7.54. 7.54. Okay. Guys, just see the illustration number 8. So whatever I have told you, whatever I explained you, this is like a revision which you will get in terms of this particular illustration. This is an important concept. That is why I am focusing so much on this particular part. MS Limited has acquired a heavy machinery at a cost of rupees 100 lakhs with no breakdown of the component parts. Okay, as we have seen. So Kaustav is saying, sir, if there is no subsequent cost of replacement, then we are not required to do anything. Yes, Kaustav, we are not required to do anything. Okay, but let me tell you, this Ind AS 16 talks about the component accounting. What is meant by component accounting? If there is a particular asset, okay, if there is a particular asset, and that particular asset has a significant parts, that particular asset has a significant parts which is having a significant value. In that case, those parts are required to be capitalized separately. Okay. For example, in case of shipping industry, in case of aviation industry, the aircraft has a different parts. For example, the aircraft has a wheel body. The wheel body has to be replaced at a period of every 5 years, which will incur a huge cost. Okay. The interior of the aircraft, the interior of the aircraft, or the body of the aircraft require a major cost after 15 years. The engine of the aircraft requires replacement after 20 years. So if there is an asset which has a significant component, and if the life is different, in that case component accounting is required. But if the life is not different and the company is getting a ad hoc major replacement at 4 years, after 4 years, after 5 years, after 6 years, in that case the breakdown is only required, and such accounting is only required when that particular event will happen. Okay, otherwise not. So MS Limited has acquired a heavy machinery at cost of rupees 1 crore. There is no breakdown of the component part. The estimated life is 10 years. At the end of 6th year, one of the major component, the turbine, require replacement. So ad hoc, the company got a replacement cost. One of the major component of the turbine require replacement, as further maintenance is uneconomical. Okay, So if the company goes to further maintenance, it is uneconomical, and the company has decided to replace the turbine, which is a critical part of the machinery. The remainder of the machine is perfect and is expected to last for the next 4 years. Okay. So the company is saying that apart from turbine, rest of the machinery is fine. There is no impact on the body. There is no impact on the other part. Okay. The cost of a new turbine is 45 lakh rupees. Okay. The total cost of the machinery was 1 crore rupees. And after 6 years, when this is happening, the current value is 45 lakh rupees of that major component. The discount rate given here, the discount rate is given in the question, which is 5%. Can the cost of the new turbine be recognized as an asset? And if so, what treatment should be used? So there are two questions. The first question is, can it be recognized as an asset? And if yes, then what will be the treatment? Okay. So I am just unsharing this and I am moving on to the whiteboard. First thing is, what is the cost of the asset? What is the gross block? What is the gross block? I am splitting this into two parts. So first question is whether the cost of turbine is a major cost or it is a day-to-day cost. Guys, the cost of the turbine is a day-to-day cost or major cost? Is it a major replacement or day-to-day cost? It is a major replacement. It is a major replacement. Whether it is meeting the recognition condition. Is it meeting the recognition condition? Future economic benefit is probable. Answer is yes. It is given in the question. If the company will replace the turbine, the rest of the machine is perfectly fine and it will run for the next 4 years. And the cost is known. We are aware that 45 lakh rupees has to be incurred. So yes, it is meeting the recognition condition. Okay. Now what we need to do? So we have to add 45 lakh rupees in the cost of the machinery. But we need to de-recognize the existing cost of the turbine. We need to de-recognize the existing cost of the turbine. Okay. So what to do in this case? What is the life of the turbine? What is the life of the machine? 10 years. So gross block. What is the gross block? So I am splitting this into two parts. One is turbine. So one is other than turbine, other than turbine. And the second one is turbine. First of all, what is the total value? The total value is 1 crore, 100 lakhs. What is the accumulated depreciation? What is the life? Life is 10 years. So this is illustration number 8 of Institute Study Material, page number 7.54. Page number 7.54. Yes. Yes. So what is the accumulated depreciation? What is the depreciation every year? Total cost is 1 crore rupees. Life is 10 years. So 1 crore divided by 10 lakh rupees. Okay. So if per annum depreciation is 10 lakh, then what is the total 6-year depreciation? Accumulated depreciation for 6 years, it is 60 lakh rupees. What is the net block? 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 Net block is 1 crore minus 60 lakh, 40 lakh rupees. Now what we need to do? We need to split. We need to split this 1 crore between turbine and other than turbine. Am I right? So how to determine that? This 45 lakh have been incurred. 45 lakh have been incurred today. Then what is the cost? What is the present value before 6 years? Okay. So this is incurred today. Then what was the cost before 6 years? Discount rate is given at 5%. Discount rate is given at 5%. Okay. So 45 lakh divided by 1.05 to the power 6. Okay. So what is the discount rate? 1.05. 1 divided by 1.05. Again divide by 1.05. Again divide by 1.05. again divide by 1.05, again divide by 1.05, again divide by 1.05, again divide by 1.05. So it is giving me 0.710. It is giving me 0.710. Okay. So 0.710 multiplied by 45 lakh. So it is giving me 3195. Sorry, I think I have added one more 1.05. So if we, so let me write here. First year, second year, third year, fourth year. So first year, what is the PV? 1 divided by 1.05? 0.952. 0.952. What is second year? 1. So 0.952 divided by 1.05. 0.906, 0.907. Then what is the third year PV? Divided by 1.05. 0.863. What is the fourth year PV? 0.822. What is the fifth year PV? 0.783. What is the sixth year PV? 0.746. 0.746. So the sixth year PV is 0.746. Okay, 0.746. So 45 lakh multiplied by 0.746. 45 lakh multiplied by 0.746. So it gives us multiply by 45 lakh. So 33, 56, 626. 33, 56, 626. So in the round figure, I can say as a 33 lakh 57,000. Okay. And what is the remaining part? So 1 crore 100 lakh minus 33 lakh 57,000. 66 lakh 43,000. It is the remainder. Okay. So now the total depreciation is 60 lakh. So this has to 60 lakh. If I divide 6643 divided by 10, 6643 divided by 10 multiply by 6, it is 39 lakh 85,800. And 3357 divided by 10 multiply by 6, it is coming at 20 lakh 14,200. So what is the net block? The net block of turbine is 3357, 13 lakh 42,800. And what is the net block of other than turbine? The net block of machinery 6643 minus 39 85 800. So it is 26 57 200. So this total is 60 lakh. This total is 40 lakh. Okay. So what is the net block of turbine available to the company? 13,42,800. So what will happen with this? What will happen with this? What will be the accounting entry? Now the accounting entry will be the new turbine will be added to the cost of the asset. So what will be the accounting entry? Turbine account debit. Turbine account debit 45 lakh to bank account. So this will be added to the cost of machinery and it has to be depreciated over the remaining life of 4 years. Okay. And what about existing turbine? So under existing turbine, you have to debit accumulated depreciation debit, which is 20 lakh 14,200 to old turbine credit 33 lakh 57,000. Loss on replacement will go to P&L. Loss on replacement will go to P&L, which is 13 lakh 42,800, which is nothing. It's a net block. 13 lakh 42,800. Okay. So this will be the accounting entry. I hope it is clear to everyone. Just for the ease of calculation, I have taken this as a 33 lakh 57,000. So you can do on the absolute number basis. Okay. Guys, are you clear on this? Are you clear on this? Please let me know if you have any query. So I have already explained you the concept of a truck. Before this case study, I have explained with my own case study, which was a life of truck of 15-year engine is getting replaced after 5 years. Okay. So now this is a case study from the institute study material, and it is very relevant, very important part. Okay. So friends, in case of major inspection, in case of major overhauls, in case of major replacement, you are required to treat this as a subsequent cost. Okay. It is required to be capitalized, and you are required to de-recognize the existing part. Okay. Are whether all of you are clear on this? Please confirm. Otherwise we will have a 10 minutes break. So guys, now we'll have a 10 minutes break. It's 8:40 now, so we'll start at 8:50. Okay. So let's have a 10 minutes break. So friends, before this break, we have learned about the concept of subsequent cost and initial cost. So initial cost at the time of recognition and subsequent cost at the time of recognition. And I have told you that if there is any major cost in terms of major replacement, major overhauls, and major inspection. Okay. For example, you are carrying a two-wheeler, or you are carrying a vehicle, for example a car, and you are getting an inspection cost of rupees 10,000 every year. Okay, so that is not a major inspection cost. But if I talk about shipping industry, or if I talk about aviation industry, so according to aviation rules, so they need to go for a major inspection after a particular set of flying hours, or after a particular set of intervals. Even though the aircraft is airworthy, the aircraft is flying very fine, there is no any issues, but still they have to go for a mandatory inspection, and this will take a huge cost. Okay, so in that case, that major inspection cost has to be capitalized as a separate component. It has to be de-recognized, and the new cost is required to be capitalized, same way like we have discussed in case of turbine and in case of engine for a truck. Friends, I understand you all are comfortable so far. You are able to understand the concept, whatever I have told you so far in the last 1 hour and technically 40 minutes. Okay. So let me know if you have any issue. Let me know. I request the response of you guys. So I have only received the response of 2-3 students. I request more participation, more response, so that it will be beneficial to you guys. I have told you, the more you interact, the more you learn. The more you participate, the more you understand. Okay. So let me share my screen again. So major inspection and overhauls, I have told you that regular major inspection for faults may be a condition of continuing to operate an item. For example, in case of aircraft, the cost of each major inspection is recognized in the carrying amount as a replacement if the recognition criteria are satisfied. For example, an aircraft, when aircraft was purchased, it was already inspected. Okay, the life of the aircraft is 20 years. But aircraft has to undergo with a major inspection at an interval of after 5 years, at an interval of 5 years. Okay. So the thing is, if the aircraft will not get inspected after 5 years, whether the company is able to operate and maintain the aircraft, whether the company is able to operate the aircraft, answer is no. Although the aircraft is airworthy, although the aircraft is fit for flying, but since it has not undergone with a major inspection, it cannot operate that particular aircraft. Okay, so it means by incurring a major inspection, the company will get a future economic benefit for another 5 years, and the cost is measured reliably. So in this case, this major inspection cost is also required to be capitalized as a subsequent cost, like we have seen in the case of major replacement. Any remaining carrying amount relating to the previous inspection is de-recognized, irrespective of whether previous inspection was separately identified and depreciated. Same concept. If you are aware about the initial cost, you are required to de-recognize. If you are not aware about the initial cost, you are required to use the current cost as a base, and you have to calculate the present value before 4 years, 5 years, 6 years back, when that aircraft was originally inspected or originally purchased. Okay. Siddharth, Kaustav, Chavi, Preeti, have you all clear on this? Okay. So quickly we will do this case study from this PowerPoint presentation. So friends, this PowerPoint presentation will be uploaded today or in some time. Okay. So don't worry about that. Udan Limited buys an aircraft for rupees 90 lakhs. Under civil aviation rules, the aircraft requires a major inspection every 3 years at a cost of rupees 5 lakh. 3 years after purchase, it undergoes its first major inspection. So when the aircraft was purchased, the cost was 5 lakh rupees. Okay. 3 years after purchase, it undergoes its first major inspection after 3 years. The cost in relation to this inspection amounting to rupees 7 lakhs. Explain how the same should be accounted for in accordance with the requirement of Ind AS 16. So friends, first of all, let me tell you the total cost of the aircraft is 90 lakhs, but it has already been given that after every 3 years, this aircraft is required to be inspected. Okay. At a cost of rupees 5 lakh. It means when it was acquired, had the company done the inspection separately, the cost would have incurred at the cost of rupees 5 lakh. So what is the total cost of aircraft? 90 lakh. The cost of inspection component is 5 lakh. Other than inspection component, I mean to say complete aircraft is 85 lakhs. Okay. So this is the bifurcation of 90 lakh. After 3 years, the original inspection cost had been incurred at rupees 7 lakh. So in this case, we will de-recognize existing inspection cost, which is 5 lakh, and we are required to recognize 7 lakh. So what is the gross block? 85 lakh plus 5, which was there, minus 5, which is de-recognized, plus 7 lakh. So total gross block will be 92 lakhs. Okay. Total gross block will be 92 lakhs. So this is the accounting treatment. Okay. So guys, are you clear on this? Are you clear on this? So I am getting a less response in the last 10-15 minutes. So what should I understand? You are not able to understand the concept. This is a very interesting chapter, very interesting standard, and very important standard too. Because whatever concept you are learning in this standard, you will face the same concept in the remaining standards. Some of the same concept. I will just wait for another 2 minutes to see if you have any query. Let me know if you have any query. Otherwise, I have to move on. Only 3-4 students have responded that they have understood. What about others? Don't hesitate. If you have understood everything, it would be great if you will respond, yes, sir. Great. So Pujita is clear, Kaustav is saying understood, Ambika is saying, sir, inspection cost would have been depreciated. Yes, Ambika, you are right. So Ambika has a very good point here. So Ambika is saying, sir, since you are, so let me unshare this screen so that you will have a complete visibility of the whiteboard. Ambika is saying, sir, you have already told, for example, the life of the aircraft is 20 years. Life of the aircraft is 20 years. And you are saying that it is required to be inspected at every 3-year intervals. So you have splitted inspection cost, inspection component, and other than inspection, which is complete aircraft component. So 5 lakh and 85 lakh. Okay. Total is 90 lakh. So since we are aware that this component has a life of 3 years only. This component has a life of 3 years. And this component has a life of 20 years. Okay. So in this case, this inspection cost has to be depreciated over a period of 3 years. And by the time when the company is ready for inspection, the accumulated depreciation is 5 lakh. And net block becomes 0. Net block becomes 0. And this has to be depreciated annually over a period of 20 years. So there could be some value in the aircraft, but as far as inspection component is concerned, this becomes 0. Okay. Understood? Because we have to follow component approach of accounting. Preeti Singh, sir, here we cannot separate inspection cost, depreciation. So Preeti, why we cannot separate? We can separate. So this inspection component has to be depreciated over a life of 3 years, and the remaining aircraft component has to be depreciated over a life of 20 years. So in the question, the life was not given. The life of only inspection component was given. Okay. But let's assume the life of the aircraft is 20 years. So in this case, both the components has to be depreciated over a different useful life. So this is a requirement of Ind AS 16 and AS 10. Is it okay, Preeti? What about others? Except 5-6 students, what about others? Are you not able to understand? Okay, let's move on to the next part, measurement. Okay, great. Let's move on to the measurement. So we understood the recognition concept. Now we are moving to the measurement part. So Ambika is asking, sir, then how we are de-recognize directly 5 lakh? Ambika, so I am talking about gross block. So there are two concepts. One is gross block, one is accumulated depreciation. When I am saying de-recognizing 5 lakh, I am talking about gross block. So then accumulated depreciation was also standing at rupees 5 lakh. So technically loss on replacement will be 0. Okay. So accumulated depreciation debit 5 lakh to inspection component 5 lakh. Is it right, Ambika? Okay, great. Now, sir, what about safety equipment? When you go to the malls or when you go to some companies or when you go to theater, multiplexes, you will see some fire extinguisher. You will see some fire extinguisher. Okay. When you go to the acid factories or chemical factories, you will see some, filtration plant or cleaning plant. Okay. You will see some purifier, air purifier, water purifier. So we'll see these kind of safety and security equipments. Okay. Now the question arises, these safety and security equipment, whether it will be capitalized as a PPE, whether it will be recognized as PPE, cost can be measured reliably. But what is the future economic benefit which is getting out of it? Tell me, whether whether safety and security equipments like fire extinguisher, filtration plant, purifiers, whether these are required to be capitalized as a PPE. What future economic benefit we are getting out of it? The standard says that although the safety and security equipment is not providing the future economic benefit directly, but they are providing the future economic benefit indirectly in support of the other assets. For example, as required by the law and regulation, if the company will not have a fire extinguisher, the company may have a risk of fire. Okay. And probably the company cannot operate without installing all those equipments. Okay. So that is why these are indirectly administratively supporting the company to work smoothly. Okay. So that is why this safety and security equipment are also required to be capitalized and recognized as a property, plant and equipment. Okay. Understood? Now we are moving towards measurement. Measurement at initial recognition. Measurement at initial recognition. So let me see if there is any query of anyone. Yes, Ambika, you're right. This security and safety equipment act as a supportive equipment to future economic benefit. Siddharth, are you clear on all this concept? Siddharth, where are you, Siddharth? Okay. Yes, guys. So let's move on to the next concept. So measurement at initial recognition. So initially, measurement at initial recognition. Initially, when the company is purchasing or acquiring any asset, any PP, it has to be recognized at cost. It has to be recognized at cost. It has to be recognized at cost. What is the component of cost? That is very important. So what is the component of cost? So cost includes purchase price. The cost includes purchase price, including import duties and taxes. If there is any import duties and taxes, that has to be added. import duties and taxes. Import duties and taxes, purchase price plus import duties and taxes plus non-refundable taxes plus non-refundable taxes. Non-refundable taxes minus, what is minus? If the company is getting any trade discount and rebate, if the company is getting any trade discount and rebate, it has to be deducted. Trade discount and rebate. For example, the company has purchased a machinery from China. So the cost was rupees 10 lakh. The cost was INR rupees 10 lakh. Okay. The import duties and taxes which have been incurred is rupees 2 lakh. So 2 lakh will be added in the cost of the asset. Okay. There are some non-refundable taxes. There was some GST when the machine has moved into the territory of India. So I'm just taking an example. I'm not a tax expert. So the government has charged a GST of rupees 3 lakh rupees. GST of 3 lakh rupees. Okay. So that 3 lakh rupees, and the company will not get an input credit of rupees 3 lakh rupees of 3 lakh rupees. So it will be added to the cost of the asset. But if the company is able to get the input credit of 3 lakh rupees, it will not be added as a cost of the asset. Okay. And the company has received a discount of rupees 1 lakh on this machinery. So 1 lakh rupees has to be deducted while arriving at the cost of the asset. Okay. Understood? Okay. Now what is the second part? The second part is directly attributable cost. What is meant by directly attributable cost? Can anyone give me an example of directly attributable cost? Directly attributable cost. Can anyone give me an example of directly attributable cost and what is meant by directly attributable cost? What is meant by directly attributable cost? I would appreciate the response from all of you. Directly attributable cost means had the asset not been acquired, the cost would not have been incurred. Directly attributable cost means the cost which is directly associated, which is directly related with that particular asset. Okay. For example, if the company has not purchased the machinery, the installation and assembly cost would not have been incurred. Am I right? If the company would not have purchased the machinery, the installation cost would not have been incurred. So this is example. This is the meaning of directly attributable cost. Had the company not purchased the machinery, the freight cost, the transportation cost, the carriage cost would not have been incurred. Had the company not acquired a machinery, the professional fees of consultant who is required to start that machinery, to install that machinery would not have been incurred. So these are known as a directly attributable cost. Okay. So Ambika is saying cost of transportation of asset. Pujita is saying transport labor needed to get the PP to the location. Yes. So any cost which is required for getting the asset into the condition and location necessary as intended by the management. Okay. Into the condition. Condition means we need to brought the asset into a condition when the asset starts giving a productivity. Okay. And we need to bring the asset to a location where the asset is required to be installed and required to become a productive asset. Okay. So directly attributable cost means that cost which is required to bring the asset in the location and condition necessary for it to become a productive asset. Okay. So directly attributable cost in a layman sense means had the asset not been there, the cost would not have been incurred. As simple as that. As simple as that. Vaibhavi is saying freight or transportation cost. So Kaustav is saying, for example, directly attributable cost, transport cost of asset. Absolutely all right, students. So great. You are great students. So guys, yes, this is the meaning of directly attributable cost. Now the third one is estimated cost of dismantling. Estimated cost of dismantling. dismantling, estimated cost of dismantling, asset retirement obligation, site restoration obligation. So initial estimated cost of dismantling or asset retirement obligation. So this dismantling cost is also known as a ARO, asset retirement obligation. It is also known as a site restoration obligation, SRO, ARO, SRO. Okay. Now tell me, what is meant by the dismantling cost, ARO cost or SRO cost? What is meant by dismantling cost? What do you understand about this? Can you give me the name of any company which is having a huge cost as a asset retirement cost in its balance sheet? Can you tell me the name of a company? I can give you an example. It could be a petroleum company, gas company. It could be a infra company. So can you name the company? Guys, you all are CA final students. You all must have done part of your articleship, or few of you must have completed your articleship. Reliance Industries Limited. Bharti Infratel Limited, Eban Offshore Limited, ONGC Limited, Gas Authority of India Limited. When you look at the balance sheet or annual report of Reliance Industries Limited and Bharti Infratel Limited, okay, you will see a provision, a long-term provision of asset retirement obligation, a long-term provision of asset retirement obligation. Okay, so what is that asset retirement obligation? If I talk about asset retirement obligation, so this will work as a directly attributable cost. For example, so let me talk about Bharti Infratel Limited. So Bharti Infratel Limited is a company which is into installation of towers. Okay, so you must have seen the tower which are installed on the rooftop of the premises or on the land. Okay, so there is a ground-based tower, there is a rooftop tower. Okay, okay. So friends, in case of tower industry, when the company is installing a tower, there is a contract of 15 years or 20 years. Okay. So after 15 or 20 years, the company needs to dismantle the tower. The company needs to dismantle the tower. The company needs to dismantle the tower and restore the land or restore the roof in the same condition in which it has been acquired from the landlord. Okay. Or in case of a Reliance Industries Limited, so Reliance Industries Limited has a oil well in the Krishna Godavari basin, which is given by the government. Okay, so they have a oil well in the seabed. Okay, so government has told them that after 30 years, when you go, so you have to restore the seabed in the same condition in which we have given to you. Okay, for example, you are a CA office. Okay, you are a chartered accountant office. You are a chartered accountant office. So you have you have taken a premises on a rental basis. Okay, for 10 years, and you have done a leasehold improvement. You have installed some furniture. You have done some false ceiling. So you have done some glass partition. So you have done some leasehold improvement. Okay. So when you will vacate the office after 10 years, you have to return the premises in the same condition in which it was given to you. Okay, so that will carry some cost. Okay, this asset retirement obligation, dismantling obligation will carry some cost. Okay, so friends, in this case, standard says that whatever amount you are going to incur after 20 years, after 15 years, after 10 years as a dismantling cost or a restoration cost, you are required to capitalize as an initial cost to the property, plant and equipment. Okay, but the question arises, sir, if you have to estimate the cost after 20 years, so you have to incur the cost after 20 years, then there is no any outflow, then what to do? In that case, standard says that you have to estimate what will be the cost which is incurred after 20 years. For example, it will be 2 lakh rupees. You have to compute the present value of that cost as on date. So for example, 2 lakh rupees discounted at 10% will give you 50,000 rupees. Okay, so in that case, this 50,000 has to be capitalized in the cost of the asset, debit cost of the asset, credit provision for site dismantling obligation, or provision for asset retirement obligation, or provision for dismantling obligation. Okay, this provision will be accumulated over a period of 20 years. For example, you have taken this provision on a discounted value at a discount of 10%. So every year this 10% will be unwinded. This provision for asset retirement obligation will be credited and interest cost will be debited, so that this 50,000 in 20 years will become 2 lakh rupees. Okay, but asset is required to be debited only at the cost of 50,000 rupees initially. So this concept you will also learn while learning Ind AS 37, provisions, contingent liability and contingent asset. Is it clear to you guys? Is it clear to you? Tell me, friends, students, is it clear to you? If it is not clear, just let me know. I'll explain again. Don't hesitate. These classes are just for your benefit. These classes are not for the revision of the faculty or revision of the teacher. These classes are for the benefit of the students. Guys, I would prefer, it's better to learn 8 concepts out of 10 concepts, but it should be completely. It doesn't make any sense. You have to read 10 concepts, but you are not able to understand or grasp the entire 10 concepts. But it will be always better and beneficial if you learn 8 concepts, but learn it by your heart. Is it okay? So as far as cost is concerned, initially the property, plant and equipment has been recognized at cost. Cost includes purchase price, import duties and taxes, non-refundable taxes. If it is a refundable tax, inputable tax, it is not required to be capitalized. Then trade discount and rebate has to be deducted. Directly attributable cost has to be added to the cost of PPE. Estimated cost of dismantling is required to be added to the cost of the PPE. Okay, is it okay? Great. So Kaustav is saying, sir, please explain again dismantling cost. Preeti is also saying, Ambika is okay. Great. Pujita has understood. Great. So let me explain the dismantling cost concept again. For example, the company has installed a tower. Okay. So the cost of the tower is, purchase price of the tower is 20 lakhs. The directly attributable cost like installation, like your freight, like your carriage inwards, like your inspection, labor cost, civil cost for installing the tower. These are the directly attributable cost. DAC is, for example, 5 lakhs. Okay. Now the company has entered into a contract where after 20 years, this tower needs to dismantle and site, I mean to say the space, the location, the premise needs to restore. The site needs to restore. Restore means restore in the same condition. For example, when you excavate, when you dismantle the tower, you need to do the surface cleaning, you need to do the civil work of the surface. Okay. So this dismantle cost after 20 years, this the estimated cost is 2 lakhs. Okay. Future cost is 2 lakhs. If due to installation of PPE today, we have obligated to incur some cost in future, as per Ind AS 37, we need to create a provision. Okay, I'm not talking about Ind AS 16, I'm talking about Ind AS 37. Okay, so as per Ind AS 37, we are required to create a provision for dismantling obligation, which will be arising in future. It's like a sinking fund account. It's like a sinking fund account where we need to create a kitty of 2 lakh rupees, which is going to incur in future. Am I right? For example, when you will look at the balance sheet of Bharti Infratel Limited annual report, you will see the provision for retirement obligation of 200 crores in the balance sheet, 200 crores. Okay, so the company will incur a huge cost. If the company will not create a provision on a year by year basis, the company will incur a huge hit, one-time hit in its profit and loss account, which is not correct. Okay, why this cost is incurring? Because the company is using this the asset for a period of 20 years. Okay, so that is why provision is required. Now the thing is, sir, why this cost is incurring? This cost is incurring because I'm installing an asset today. Okay, so that is why it has to be added to the cost of the asset. But sir, this 2 lakh cost will arise after 20 years. You are installing the asset as on date. Then why it has to be added at 2 lakh rupees? Then the answer is, you have to, this is a long-term provision which is going to arise in future. So you need to calculate a present value as on date. Okay. For example, discount rate is 10%. So discount rate is 10%. So I'm just taking an example. I'm not going for the exact calculation. So the present value of this dismantling obligation is, let's say, 50,000 rupees as on date when the asset is acquired. Okay. So what will be the accounting entry? What will be the accounting entry? What will be the accounting entry? So the accounting entry will be, these are the component of tower account debit. So tower account debit. In the tower account, 3 types of asset is there. One is tower, one is directly attributable cost, one is dismantling obligation. Okay, so tower is 20 lakhs. Dismantling obligation is 5 lakhs, and this is 50,000, 0.5 lakhs. Okay, 2. So this has been debited, and what is 2? What will be credited? What will be credited? To bank account or cash account or vendor account. To bank, cash or vendor by 25 lakhs. To provision for dismantling obligation by 0.5 lakhs. Is it clear? Kaustav, Preeti, Ambika, Pujita, is it clear, you guys? Is it clear to you guys? Students, please respond. Siddharth, what about you? Because this 0.5 dismantling obligation will arise in future. So there is no cash outflow. That is why we have created provision for dismantling obligation. Now this dismantling obligation will increase year by year and it will become 2 lakh rupees. And in subsequent year, the interest cost will go to P&L. As per Ind AS 37. Okay. Guys, is it okay? Can I move forward? I have to cover more concept. Can I move forward? Please tell me. I hope you are clear on this. Let me take a case study on this. If you respond, it would be helpful for me whether you have understood or not. So let me come on to the PPT now. So we have covered this concept: initially measured at cost, purchase price including import duties and non-refundable purchase taxes after deducting trade discount and rebates. Then there is a directly attributable cost which has to be added. Then initial estimate of the cost of dismantling and removing the item and restoring. Okay, so we have explained this. Then there are some example which is given under the standard for directly attributable cost. I have told you that it is a cost which is directly related to the bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. So this could include employee benefit costs arising directly from construction or acquisition of PPE. For example, there are some employees who are engaged in the construction of the factory or installation of machinery. So that employee cost, employee benefit cost, is also required to be capitalized as a directly attributable cost. Okay. Cost of site preparation. So for example, civil work, excavation. So this is known as a cost of site preparation. This is also added to the cost of the asset. Initial delivery and handling cost. So any delivery cost, handling cost, so these are also required to be capitalized as a cost of the asset. Installation and assembly cost. So installation cost of the machinery, assembly cost of the machinery, this is also required to be capitalized. This is an example of directly attributable cost. Professional fees, again an example of the directly attributable cost. Cost of testing, trial run. You have seen in case of a metro, okay, in case of metro project, in case of some big projects, there are some trial run expenses. Okay, so if there are any trial run expenses, these trial run expenses are required to be capitalized. But due to trial run, if there is some production and there is some revenue, so that is required to be deducted. Okay, great. So Ambika is saying, sir, subsequently the journal entry will be P&L account debit. Yes, Ambika, it will be interest cost debit to provision for dismantling obligation. So Kostav is saying all clear, sir. Great. So 5-6 students have confirmed that everything is clear. Great, guys. Great. Fantastic. If you have any query, just let me know. So I am just trying to explain the layman language. Okay. So guys, there are some examples which is not covered under directly attributable cost. Okay. So some examples are given in the standard. For example, if a company wants to conduct a business in new location or with a new class of customer, for example, the company has moved to China from India. Okay. So the company is providing a training of understanding Chinese language to its employees. Okay. So this cost is not capitalized as a PPE. This cost will be charged to P&L. Okay. So this is not a directly attributable cost example. For example, the company has constructed a new factory or a new plant, and for the inauguration of that plant, the company has invited Mr. Amitabh Bachchan. Okay. So do you think that Mr. Amitabh Bachchan will do a honorary inauguration? He will charge around, let's say, 5 crore rupees. So Mr. Bachchan will charge 5 crore rupees. So this cost of promoting, introduccing a new product or service, cost of opening a new facility, this will not be covered under the cost of PPE. This will be expensed off. Administrative and other general overhead costs. While doing the construction of a plant or a factory, the company was also incurred some audit. Okay, there was some security guard who is on a patrolling mode. Okay, so there are some administrative and other general overhead costs. Okay, so these are not an example of directly attributable cost, and these are required to charge to P&L. Understood? So these are examples which are given under the standard. So this is not the exhaustive list. This is an inclusive list kind of thing. Decommissioning cost, I have explained you that the cost towards dismantling and removing the asset and restoring the original site after use. The corresponding obligation recognized as a provision under Ind AS 37, which talks about provisions, contingent liability and contingent assets. So typically it is arising in oil and gas, mining, electricity and infrastructure industries. Like the classic example is telecom passive infra companies like American Tar Corporation, Bharti Infratel Limited, Indus Tar Limited. Okay. So for example, building an additional internal wall with condition that property will be returned in the original state at the end of the lease. Okay. Friends, are you clear so far? Now let's do a comprehensive case study on this measurement part. ABC Limited purchased a furnished machinery for a gross price of rupees 200 crores. The seller granted 0.5% rebate on the gross price of the machinery. The gross price includes excise duty of rupees 20 crores for which input credit can be claimed by the company. Okay. I request all of you to respond. I request all of you to respond which cost is required to be included, which cost is not required to be included. Okay. So we are talking about the measurement and initial recognition. Yes. So ABC Limited purchased a furnace machinery for a gross price of rupees 200 crores. Okay. So what is the gross price of the machine? It is 200 crores. The seller granted 0.5% rebate on the gross price of the machinery. So guys, there is a rebate. So what is the treatment of rebate? What is the treatment of trade discount and rebate? What will be the treatment? So purchase price. Okay. Then there is a rebate. So rebate is required to be deducted. Please remember, when you have read the element of cost, purchase price plus import duties plus non-refundable taxes minus trade discount and rebate. Okay. So the gross price includes an excise duty of rupees 20 crore for which input credit can be claimed by the company. Or you can say it includes GST because there is no concept of excise duty now, it is GST. So the gross price includes GST of rupees 20 crore, which is a refundable tax, which is not a non-refundable tax, it is a refundable tax. So if it is a refundable tax, it is required to be deducted. Am I right? Non-refundable tax is required to be capitalized. It also incurred rupees 15 crores as a transportation cost, handling charges and insurance. Rupees 5 crore for installation and 3 crore for testing and professional fees. So what about these costs? These are the directly attributable costs and is required to be capitalized. Okay. Transportation, handling and insurance. Transportation, handling and insurance. So these are the directly attributable cost. Apart from this, there is an installation cost and testing and professional fees. So installation cost is also there and testing charges and professional charges is also there. Okay. So these are the directly attributable cost. But it has earned rupees 0.2 crores from selling goods produced out of testing. So while trial run, the company has also earned some revenue. So revenue from trial run. So this is required to be deducted. The company borrowed rupees 100 crores for financing the new purchase at the rate of 10%. And the company has also borrowed rupees 100 crores, okay, for financing this new purchase. The entire process of purchase to make the operation took 15 months. And this entire purchase, okay, this entire operation took around 15 months. The loan was outstanding during the period. So what does this point indicate? So this point is indicating the borrowing cost. Okay. So remember, you have learned the concept of borrowing cost under AS 16. So now under Ind AS, it is Ind AS 23. It says that if a loan or a borrowing has been taken for a qualifying asset, it is a qualifying asset. Yes, it is taking 15 months for completion. So that borrowing cost is required to be capitalized. So how to calculate this borrowing cost? 100 crore multiplied by 10%, multiplied by 15, divide by 12. Okay. So this borrowing cost is required to be capitalized. Okay. Are we on the same page? Great. The company earned rupees 0.1 crore from short-term parking of the money borrowed pending payment to supplier and meeting all cost. But the company has also earned some money by parking some funds into FDs. For example, the company has borrowed 100 crores. So 100 crore will not be required on a first day. This 100 crore will be expensed off in the 15 months. So the company has some fixed deposit for a small period and it earned around 0.1 crore. So standard says that if the company is earning any money out of the borrowings which have been done for asset, that revenue or that interest income is required to be deducted from the borrowing cost. Okay. So in the borrowing cost, this interest revenue has to be deducted. Short-term money. The last point is, what should be the initial cost of the machinery? So guys, we have recognized the machinery, but we need to calculate the cost on which the machinery is required to be recognized. Okay, now tell me at what cost this machinery is going to be recognized. So yes, so many of students have responded. Preeti is saying, sir, reduce 0.5% rebate and excise duty rebate. Great, you are right, Preeti. Then Chavi is saying, sir, rebate is going to be deducted. Okay, Kaustav is saying trade discount rebate. Okay, so Ambika is saying, sir, 200 minus 1. What is this 1? Okay, 0.5% rebate is going to be deducted, and 15, 5 and 3 is required to be capitalized, added. Okay, and 20 is also going to be deducted. Yes, Ambika, you're right. So friends, let's look at the screen. This is the answer which is given on the screen. So purchase price is 200 crores gross price, but the rebate is 0.5% of 200, which is 1 crore, which is required to be deducted. Please remember, purchase price including import duties and non-refundable taxes, less trade discount and rebates. So this excise duty is a refundable tax, that is why it is required to be deducted. Okay. Transport, handling and insurance charges is 15 crores. Okay. This is your 15 crores. Installation charges is 5 crore. Testing and professional charges is 3 crore. And you have a trial run income of 0.2 crore. So it has to be deducted. Borrowing cost is 100 crore multiplied by 10%. It is for 15 months, so 15 by 12, which is 12.5 crores. Short-term income is 0.1 crore. It is required to be deducted. So the total cost of the machinery is 216.20 crores. So Pujita, it is not 214.2. It is 216.2. Am I right? So 179 plus. Let me do this calculation. So 179 plus 15 plus 5 plus 3 minus 0.2 plus 12.4. Sorry. So my number is not correct here. It is 214.2. Guys, this is 214.2. It is not 216.2. Okay. So Pujita, you're right. Ambika, you're right. Yes, Rohan, you're right. It is not 216.2. It is 214.2. Okay. So purchase price is 200. Again, this rebate is going to be deducted -1. This refundable tax is going to be deducted -20. Transport, handling and insurance is added 15 crores. Installation is 5 crores. Testing professional 3 crores. Minus 0.2 crore is deducted. Borrowing cost is 12.5. Minus 0.1 is income. This total is 214.2 crores. 214.2 crores. So this is the entire solution of this case study. Yes, Ambika, you're right. This is 214.2 crores. Yes, you're right. Kaustav, you're right. Guys, can I move on to the next concept? Is it okay with you guys? So please write down the homework, which is illustration 9. Please write down, you have to do the homework. You have to do illustration 9 at page number 7.55. Yes, Ambika, the PowerPoint presentation will be uploaded today or tomorrow in the Board of Studies portal. So friends, please write down the homework. In this aspect, you have to do the illustration number 9 at page number 7.55, which talks about element of cost. Okay, so you have to do that. Then you have to do the illustration number 10. you have to do the illustration number 10. Illustration number 10 at illustration 10 at page number 7.56. Please write down the homework. Illustration number 9, page number 7.54. Illustration number 10, sorry, page number 7.55. Illustration number 10, page number 7.56. Yes. Okay. So now we have discussed the element of cost. We have discussed the measurement at cost. We have discussed the measurement at initial recognition. So we discussed that the measurement at initial recognition will always be at cost. Now, while discussing the measurement at initial recognition, we'll discuss. So technically speaking, we have discussed that measurement at initial recognition, IR, measurement at initial recognition, IR. Okay. So we discussed the concept of when the asset is acquired, I mean to say purchased or constructed. When the asset is acquired or constructed, so we have to add the purchase price of the item or material, purchase price, import duties, non-refundable taxes, less trade discount and rebate. If there is any directly attributable cost, that has to be added. If there is any estimated cost of dismantling, that has to be added. Okay. So we talked about this acquired or constructed part. Now, there is one more concept, deferred payment. So deferred payment credit. Deferred payment credit. What is meant by deferred payment credit? Deferred payment credit. Deferred payment terms. And then the last concept under this part is exchange of assets. Exchange of assets. Exchange of assets. So let me explain this. How to acquire an asset? How to acquire an asset? The first thing, you go to the market, purchase an asset. Okay. You go to the market, purchase some items. Okay. And you need to construct the asset. The third one is deferred payment terms. So you go to the market and bought the asset on a credit basis. Okay. For example, I went to the Maruti showroom and I asked that I want to purchase a Swift car. Okay. So again, Chavi also went to the Maruti showroom and Chavi also asked that I also want to purchase this Maruti car. Okay. So Chavi asked, what is the price? So the dealer told her that the price is 5 lakh rupees. So Chavi has given a check of rupees 5 lakh rupees and got the car. Okay. So this is a cash price. This is a cash price. I told the dealer, I don't have 5 lakh rupees. I have only 1 lakh rupees and I will repay this remaining 4 lakh rupees after 2 years. Now tell me whether the dealer, if the dealer is selling the car at a deferred payment credit terms, or the dealer is selling the car at a deferred payment terms, whether he will give me the car at 5 lakh rupees. So the dealer has sold the car to Chavi at 5 lakh rupees, but whether the dealer will sell the car to me, to Alok Garg, at 5 lakh rupees, answer is no. Why? Because there is a concept of time value of money. Okay. So if I will pay 4 lakh rupees after 2 years, it means the dealer is losing interest on its capital. Okay. So the dealer will charge something. So it is like a funding transaction. It is like a financing transaction. So he will say, okay, no worries. Just give me a guarantee. So give me 1 lakh rupees. You can repay 4 lakh rupees, whatever you are saying, after 2 years. But the cost of the car is not 5 lakh rupees. The cost of the car is 6 lakh rupees. Okay. So same dealer has sold the same car to Chavi at 5 lakh rupees, but he wants to sell me the same car at 6 lakh rupees. Why 1 lakh rupees extra? Guys, why 1 lakh rupees extra? Just let me look at the query screen. If there is any query in between. Why 1 lakh rupees extra? Because it includes the cost of the capital. It includes the interest cost. So Chavi will recognize the car in its books of account at rupees 5 lakh, which is the cash price equivalent. And I will recognize the car at 6 lakh rupees in my books of accounts. Don't you think this would not be a right approach? Going by the substance, I am not paying 1 lakh rupees extra for the car. I am paying 1 lakh rupees extra for the capital, for the cost of the funds. So don't you think that the asset is required to be recognized at cash price equivalent? Don't you think? And 1 lakh rupees over and above 6 lakh minus 5 lakh, this has to be recognized as an interest cost, borrowing cost. Okay, sir, but there is a standard called as Ind AS 23 which says that if it is a qualifying asset, this borrowing cost should be capitalized. You are right. If it is a qualifying asset, car is not a qualifying asset. Car is ready to use when you have acquired. Car will not take a substantial period of time for getting ready for use. Am I right? Guys, am I right? Students, my dear friends, my dear future chartered accountants, am I right? Car is not a qualifying asset. The moment you purchase the car from the showroom, you can drive the car and take it to anywhere. Okay, so that is why this will go to P&L. Okay, but sir, what will happen if the company has taken some machinery which is a qualifying asset and the company has paid money at a deferred payment terms and the company will pay interest? In that case, this interest cost will be capitalized as a part of the Ind AS 23 borrowing cost. Okay, is it okay? So friends, this part we have covered. This deferred payment terms, if it is on a deferred payment terms, then it has to be recognized at cash price equivalent. Cash price equivalent. Okay, cash price equivalent. And interest is required to be charged into P&L, except as per Ind AS 23, except as per Ind AS 23, which is a borrowing cost standard. Okay, so if the underlying asset is a qualifying asset, then it is required to be capitalized, otherwise not. Okay, so let me see the query screen. If there is any query, I'll answer that, otherwise I'll move on. Great, guys. So let me show you an illustration on deferred payment credit quickly. Okay, so guys, let me share a Ind AS 16 material, ICAI material. So quickly I'll explain this part. Just a minute. Okay, so there is a question, there is a illustration number 1 on deferred payment credit at page number 7.38. It would be great if you can open that particular question. Page number 7.38, illustration number 1. Okay, if you will look at that particular illustration, it talks about on 1st April 2001, an item of property is offered for sale at rupees 10 million with payment terms being 3 equal installment of 33,333 over a 2-year period. Payments are made on 1st April 2001, 31st March 2002 and 31st March 2003. So friends, on 1st April 2001, what is the cost of a property? The cost of the property is 1 crore. 1 crore. Okay, and the payment has to be made in 3 installments. And what is the installment? On first, this has to be made into 3 parts. On 1st April 2001, 33,33,333 needs to be paid. At the end of the first year, that is 31st March 2002, again same amount needs to be repaid. Again after second year, at the end of second year, 31st March 3, same amount needs to be repaid. Okay. Okay. So interest rate of 5.36%. Interest rate is given in the question. Interest rate 5.36%. This is illustration number 1 of Institute Study Material, page number 7.38. Page number 7.38 of Ind AS 16. It is module number 2. Okay. Now the question is, so you are required to present how the property will be recorded in accordance with Ind AS 16. So first of all, the property is recorded at cash price equivalent. So cash price equivalent is not given in this question. Then what to do? Interest rate is given in this question, 5.36%. It means you have to calculate the present value of the property. How to calculate the present value of the property? So there are 3 payments. The first payment is 1st 4/2001. The second one is 31st March 2002. The third one is 31st March 2003. 33, 33, 333. 33, 33, 333. 33, 33, 333. So what is the discounting factor? What is the discounting factor? So this payment has to be made on the same day when the company is purchasing the property. So the discounting factor is 1. Okay. What is the next discounting factor? So rate of interest is 5.36. So 1 divided by 1.536. It is it is 1 divided by 1.0536. It is 0.949. 0.949. In the next year, it is 0.949 divided by 1.0536. It is 0.901. 0.901. So when I multiply this will become, so present value is 33,333. This will be 33,333 multiplied by 0.949 is 31,63,333. 31,63,333. Again, this 33,33,333 multiplied by 0.901 will give you 30,03,333. 30,03,333. So technically the total is 95 lakhs. So what is the present value? What is the present value? Present value is 95 lakhs. Present value is 95 lakhs. So what will be the accounting entry on day 1? What will be the accounting entry? Property account debit. Property account debit. How much? 95 lakh. 2. Bank account. By how much? 33. First installment. 33,333. 2. Vendor account, creditor account or payable account. 2 payable. How much? 95 minus 33,333. 61, 66. 61, 66, 667. 61, 66, 667. So this is the first entry which is required to be done on 1st April 2001. On 1st April 2001. Okay. Is it okay? Friends, let me know if you have any problem in this. Is it okay? Guys, I would request at least 10 confirmation if it is okay. What about Ambika, Pujita, Chavi, Kaustav, Siddharth, Priti? Okay, Vibhavi. Okay. So what will happen on 31st March? What will happen on 31st March? On 31st March. So interest has to be charged. Interest has to be charged. Okay. So company will debit interest. I am assuming this property is not a qualifying asset. This property is ready for use when acquired. So what will be the entry on 31st March 2002? Interest expense debit. Interest expense debit. How to calculate interest expense? The amount payable is 61, 66, 67. 61, 66, 667 multiply by 5.36% for 1 year. It is 3,30,533. 3,30,000. So 3,30,533. So this, by this amount interest will be debited. Okay. Two bank will be credited. Two bank by how much amount? Two bank again same installment amount 33, 333. And what will be the remaining balance? It will be payable account. So payable will be debited. So payable will be debited by how much? 33 minus interest amount 335.33, which is 30 lakh 2,800. So this will be the second year entry. Okay. So how much balance has been left on 31st March 3? How much balance has been left on 31st March 3? The last installment, 31st March 2003. So the balance has been left in the first year 61, 66, 667 was left. So 30 lakh 2,800 have been paid. So the remaining balance is 31, 63, 867. The remaining balance is, I will write here, 31, 63, 867 is the remaining balance. Okay. So interest will be charged on this amount. Have you understood? Have you understood how I have received this? 61, 66, 67 minus 30 lakh 2,800. So the remaining balance is 31, 63, 867 and interest is 5.36% on this, which is 1,69,583. So interest expense debit. How much? 1,69,583. And two bank will be credit. Two bank 33, 333 last installment. So minus 33, 333. The difference is minus 169,583. The difference is 31, 63, 750. So this is payable account. Payable account debit. So see, the difference was 31, 63, 867. It is 750. So basically, I have not done the absolute calculation. So that is why there is a difference of hardly 100 rupees. So you can write it here as a 31, 63, 867. Okay. So this amount has been nullified. So Ambika is asking, sir, installment contains interest component, sir, then PV of installment is cash price. You are right, Ambika. So that's what I have done. So I have calculated the present value of rupees 1 crore, which is 33 multiplied by 3. So it comes out as a 95 lakh. Okay. So property have been capitalized at 95 lakh and 5 lakh rupees have been recognized as a interest cost over a period of 2 years. So in the first year, interest of 330, 533 have been recognized. In the second year, interest of 169, 583 have been recognized. Okay. Understood? So friends, today we have covered the concept of, we understood what is PPE. We understood what is the objective. We understood what is the scope. Okay. We have understood that it includes every PP except PP classified as held for sale under Ind AS 105. PP classified as a biological asset. I mean to say biological asset which is related to agricultural activity. The third one is exploration and evaluation of mineral assets. Then we discussed that any item of PP which is engaged in maintaining and operating these assets, that will be classified as a PPE. Then we discussed property, plant and equipment, a tangible item which is held for use in production or supply of goods and services, held for rental purposes or administrative purposes, and expected to be used for more than one period. Then we discussed PP is required to be recognized when the future economic benefit is probable and cost can be measured reliably. Okay. The same concept lies for initial cost as well as subsequent cost, which is major inspection, overhauls, and major replacement. Okay. Then we discussed that the measurement at cost. We discussed the PP is required to initially measure at cost. If I talk about cost, it includes purchase price plus import duties plus non-refundable taxes less trade discount and rebates plus directly attributable cost. Directly attributable cost means had the asset not been there, the cost would not have been arisen. So this directly attributable cost is a cost which is required to be incurred for getting the asset into a location or condition necessary to make it productive. And we are also required to add the estimated cost of dismantling and site restoration, which is going to arise in future. And that is why we have to calculate it at a present value. And the present value on the date of purchase or construction of asset should be debited to the cost of the asset and credited to the provision for retirement obligation. Okay. Then we discussed a case study on that. Then we discussed the deferred payment terms. So in case of deferred payment terms, the asset is required to be capitalized at a cash price equivalent, like we have seen in the illustration number 1 at page number 7.38 of the Institute study material. Okay, so we have calculated the present value. We have debited the cost of the property at 95 lakh. We have booked interest cost of rupees 5 lakh over a period of 2 years, according to the reducing balances of the payable account. Okay, so this is what we have understood today. In the next session, which will be happening on Monday, we will be discussing this exchange of asset concept and measurement of after recognition, technically cost model, revaluation model, depreciation, what is going to OCI, what will not go to OCI. We'll discuss all this stuff. I would request everyone, for the best benefit of the class, just do your homework, just run through your institute study material. That is more than enough. If you have seen the study material, if you have seen the recent examination question, so most of the questions are related to the study material. Okay, so this is the Bible for you. Okay, so just stay tuned, stay safe, happy learning. Thank you so much, friends. I hope you found this session useful. Thank you so much.